Hey everyone, hopefully you're having a good day. My name's Andy, channel's Finding Value. Today we're going to go into Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics, commodities and or financial topics. So let's dive in there, let's take a look, see what's going on today. If you want to follow me, it's at Finance Square Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for potential investment opportunities, and going over the macro picture. We still have a coupon code going on called Mayday, Mayday, if you're interested in joining and learning about investing. So a couple of posts that I have put up, I said natural gas looks cheap to basically everything. This is natural gas versus crude oil. I'm using natural gas as the numerator, the first one. So when it goes up, natural gas is favorable. So natural gas is cheap when it's low and goes up. And this looks really good for natural gas in terms of its valuation. Could there still be some inventory that needs to be cleansed out before this goes higher? It very well could. But nat gas is cheap to crude oil. Natural gas is cheap to the Dow Jones Industrial Average. Last bull market, it started in 1999, where natural gas bottomed in the squeezing wedge. We broke out and did a return move, and that return move was back in 2002. Could we be in a similar situation to 2002? I think so. And this is just stating that we are very cheap in relationship to the Dow Jones Industrial Average. What do I think is going to occur? I think we could see pressure on Dow Jones to go down and pressure on natural gas to go up over the coming years. And we're coming from a very cheap valuation historically. We also have natural gas versus copper, and that's at a really cheap area for natural gas against copper. Similar setup in 1995, which was a little bit before the bull market of most commodities in 99, which is over here. But this is coming from a cheap area and could very well blow to the upside. So that looks really good for natural gas. And then natural gas versus uranium. We are off the chart cheap for natural gas. Uh, it's just, I use these ratios to gauge where the value is in the market. It doesn't mean that it will move immediately. It just says that it's cheap in relationship to other asset classes, and that it has the potential for good investments into that sector. Gold to oil ratio and oil to gold ratio. I'm kind of looking to see how oil is positioned. I view oil very similar to what this chart is telling me here. I think that this is a three hump consolidation, the 2020 blowout. The peak was 2008. That's kind of how I view this setup here. We had another similar situation in the 80s, 90s, and then it bottomed in 98, 99 and broke out of that for a big bull market. The last commodity bull market was from this circle to this circle, and oil participated in it. I think that we are in a commodity bull market that started in 2020, which is this circle here. We've broken out of the falling wedge pattern. We've been consolidating, and we have a false breakdown or breakout against gold. Now, this could pull back further and extend its way down more than what we have already. But I'm using this as a general guide for a long-term, big picture view. That's kind of how I view it. Now, this is gold versus crude oil. I'm flipping those around, and it may state a little bit different picture in the short term. So we have a downtrend here that was broken in 2008. So 2008 was the peak looking back here. So it's flipped upside down. 2008 was the peak for oil, and then we flipped it. There's the bottom for gold. So gold would have been a good purchase in 2005, 6, and even in 2008 when comparing it to crude oil. Huge monster breakout. We consolidated for a little while, and we've been continuing to move higher for a period of time. And then you got this monster blow off top where gold outperformed crude oil. That was crude oil falling in 2020. We've come all the way back down, and then we've been consolidating again to the upside. Now we're at a very cheap level historically. We're at right now 37.3. So 1 ounce of gold can buy 37.3 barrels of oil. That is cheaper than every single time in history. It was cheaper than the entire 1980s, the entire 1990s, the entire 2000s, the entire 2010s, and only one time in history, 2020 and shortly thereafter, has it been cheaper than where we are today. And people are telling me that we're going to go to $30. Now, we could go to $30 a barrel or $40 a barrel. It is still possible if we get this slowdown that is projected ahead of us, for some people at least projecting. It is still possible. But what I'm stating is that it's cheap. And the way to make money is you buy undervalued assets and sell them when they're overvalued. So it doesn't mean that it can't get more, it can't get cheaper. But I'm just going to state that we are at a very cheap price, and I would be paying attention to crude oil, and natural gas is even cheaper than crude oil. So these are areas that I would be looking at that support our modern world, which is energy consumption. Suspicious accountant, someone was saying that crude oil was going to go down. He posted a long-term chart of Chevron Corporation. He's got these red circles at the top that go above the long-term trend line. And then the long-term trend line, we have a anomaly, a +1 standard deviation for COVID black swan event. It's way out versus the trend line, way below it. We came all the way up and tagged the trend line again, and we're still below the trend line. So this is actually a buying opportunity on the long-term trend. And I know people are going to disagree. They're going to be like, oil is going to be bad because we have a potential recession coming. You guys are looking at it from a short-term perspective. What I'm stating is it's cheap and it's a buying opportunity if it falls any further. I would be an accumulator, not a seller of oil at the current price, given where Chevron trades. And I'm not saying Chevron's the company I would choose to buy. It's just using it as an example. But I use these long-term ratios to see where the value is in the market. And if we see huge value in that sector, and then the companies are trading cheap to the underlying commodity itself, which I would say a lot of them are probably fairly valued to the commodity. But that's where your opportunities are at. It doesn't matter what other people think. It doesn't matter their opinion. It doesn't matter if they're using short-term price movements to create their narratives. You have to put that all behind you and look where the opportunities are. Now, we could go down further. I'm not stating that we can't, but the opportunities are there is what I'm saying. You should be aware of how cheap it really is. And yes, it can still get cheaper. Josh Young says, oil futures market speculative positioning is the most bearish that it has been since 2002. The start of the last big oil bull market and the run from $10 a barrel to $145 a barrel. And I do think that we could potentially be in that location of 2002. Why do I think that? It's because we've got the same positioning in natural gas as 2002. Here it is against the Dow Jones. 2002 is right here. You had a falling wedge, a breakout retest, and that was when the dollar fell right here in 2002. We have a breakout of the falling wedge, squeeze up, breakout, retest, 2002. So natural gas versus Dow Jones, 2002 is where we're saying. We have very similar situations, maybe even in some of these. We have in gold, so this is crude oil versus gold, a breakout retest. 2002 was the bottom here. We have a breakout of the falling wedge. The retest is what we're doing right now, 2002. So here's even more data, if you guys want more data. You know what broke out in 2002? Canadian dollar. We've got Brazilian real breaking out. We've got all these different currencies that broke out during that time frame. Let's just take a quick look at what some of those currencies. Oh, look, we've got a potential breakout. So the breakout here, and this is the Canadian dollar versus the US dollar. And we have a breakout there in 2002 is when it bottomed, and then it broke out in late 02. What do we have going on right here? Oh, it's another consolidation that's about to break out. Really? No way. And then we look at the Brazilian real. Oh, whoa, look at this. You're telling me we have another falling wedge that is broken out and it's been consolidating sideways. What's going to cause this to move up? Weaker dollar. The dropping of interest rates. What about the British pound versus US dollar here? Oh, that's breaking a falling wedge. One, two, three hump consolidation, and it's breaking out right this second. This could be one of the first currencies that breaks out to the upside. What happened in 2002? Let's go back and take a look. We've got basically a downtrend line somewhere in this region there. And then you can say we've got a falling wedge with a little bit of a spillover there. And then we broke out all the way up to 2007. So there's your breakout. In 2001 was the bottom. 2002 is when it broke out. That also coincides with what I'm looking at for 2002. All the currencies are aligning. And you know what moves all of these metals and oil? It's the drop in the valuation of the currency. It's the denominator. That's the big deal, the denominator. And that's why I'm showing all these different currencies starting to break out. Here's another one, Australian dollar versus the US dollar. Breakout. This is a commodity currency. You guys are sleeping, some of you guys, on some of this. One, two, three, and then we have the little, it's the same setup as platinum. Same exact setup as platinum. Platinum's got the one, two, three, and it's been going sideways because the dollar has been strong. Just hasn't broken out yet. They're all interconnected. Gary Savage says the average trader will invariably sabotage his investments by losing sight of the big picture and instead concentrating on the day-to-day wiggles, if not the minute-to-minute wiggles. There's no better example exists than the frustration gold bugs are exhibiting right now because gold is taking a few days to break out above $2,550. They are completely missing the big picture that gold is in the middle of a massive breakout from a 13-year cup and handle basing formation. Completely agree. And go look at silver. Silver's about to just absolutely rip. So what tears people up is they create narratives based off of short-term market movements. The big picture eludes all of the retail investors. Wall Street Silver says, are you making $100,000+ of income or higher? Are you living paycheck to paycheck? Most people seem to upgrade their house, their car, and their lifestyle as their income goes up. It is easy to see how it happens. $100,000 per year after taxes is not a wealthy lifestyle. It says, what amount per year is wealthy where you're not really concerned about day-to-day bills any longer? I think it's around 250,000. And this is stating that 63% of Americans are living paycheck to paycheck, including nearly half of the six-figure earners. Do you want to know how you get out of this? How do you get out of this? How do you get out of the paycheck to paycheck thing? Well, you're going to have to cut your costs and have some sort of buffer of cash. You take that cash, you buy assets with cash, and then you continually buy assets with cash. And then your assets start to generate returns for you. Those returns can be returned to, back to you through dividends. So if you want to get out of this race, the way that you do it is you don't spend as much as you earn. You create a 20%, 30%, 40%, 50%, whatever you can do. You save that 30, 40, 50% and invest it. You buy assets with it. Then you use those assets to generate income for you. It's like playing the game of Monopoly. And the way to get out of the rat race, or the way to get out of it, is to not play the game anymore in a 9 to 5. You have to figure out a way to generate cash and money outside of a 9 to 5 job that will get you income. And that's what buying assets does. Whether it's buying and renting homes, or it's buying dividend income, or it's buying whatever it is, you have to buy assets that produces income. So then you start to get separate streams of income. And that's where you become more resilient. So you've got one income of 100 grand. Well, what if you have a dividend income of 100 grand? Now, does your 100 grand income matter that much? No, it doesn't, because if you have dividend income that pays all of your bills, you're good. You're good, and you can have, I'll call it the FU money. Here's another one. This is oil price and yield curve 210 below it. So I took a long-term oil price chart. And then I said, okay, I just took where the bull markets are. That's what the bull market from green to green, green to green, and we started the new green arrow for a bull market. This is the yield curve going up and down during that bull market. So we did have the yield curve. Generally speaking, the way that I view it is when the yield curve drops, whenever you get these drops, it initially kills oil at some point. Now that's before this curve existed. This is 1987. But usually you get like a pullback initially, like here. That pullback was the initial pullback here. You have another pullback here, which is the initial drawdown in the beginning of it. We have another pullback that we have here recently, and that's from the beginning of this yield curve on inverting. It's going to bottom out, and in my guess, this is the first wave, and we're at the bottom of the second wave here, and we're about to start the third wave of a big move in oil, uranium, and all these different commodities. The problem that people have is that all they worry about is the immediate future. The big picture eludes them. This here is a big picture roadmap, is what I'll call it. And what you want to see is you want to see commodities that are cheap at the beginning of it and commodities that are expensive at the end. And oil plays along with that commodity bull market. This is one of the drivers of it. Right now, we're going through a slowdown in the market, and the yield curve could uninvert. We could see oil go down in the beginning of it, which we're seeing right now. And I think that where the circle is where the circle is where we're at. We're at 2001, 2002 is where we're going to approach here over the next 6 months. So we could get a further pullback in oil. We could go down to 55 even. That would be a fib retracement of about 0.718 or whatever it is. And that would be a $55 level. We might not get that far. We might only get to the 60s. It's hard to say exactly to pinpoint a precise dollar value. What we're looking for is a bottom over the next 6 months or so. So the bull market, it exists. We are in the bull market, in a big secular bull market. It's the green to green arrow is the secular bull market. But in those bull markets, you could see that we had a big pullback, a 40, 50% pullback to do a retest of this breakout. And we're doing a retest of the breakout right now. And people don't even know it. They're going to say, oh, oil's bad. We're going to get a recession. It's going to go down to $30. That's still a higher high from the 0 point that we made in 2020. Higher highs, higher lows. We have broken the downtrend line because we've made a higher high at 120 than the last high of about $80 that occurred in the late 2010s. Like, I don't know how to say this, guys, but if you don't, you have to be able to understand the big picture view if you want to make big picture money. The big money is made by playing the big move. You don't make big money by playing small moves unless you take incredible risk and put incredible leverage on it, which most of the time, at some point, you're going to get blown out, like Jesse Livermore. He got blown out multiple times because he put all this leverage and was playing shorter term moves. The bigger, longer term moves is what Buffett and all these other guys are playing. But it takes patience. You have to adopt a strategy that most people don't want to adopt because they're impatient. And then you just take all the money from the impatient people. AKA Warren Buffett's quote, the markets are there to transfer money from the impatient to the patient in terms of patience. And that's what you have to adopt. You have to learn the game and be the game. This is a 10-year yield long term. We've got a downtrend all the way to 1941. We had a big uptrend in yields all the way to 1981. We had a big decline from 81 all the way to the bottom of 2020. We broke that in 2021 into a new increasing interest rate environment. And you know what did well in this environment? Gold, silver, hard assets. That's what's going to do well here. Now, we could get a pullback. Inside of this is called the secular trend, the secular downtrend, the secular uptrend, the secular downtrend, and then the secular uptrend that just started. A cyclical pullback are these ones that go back here. So a cyclical pullback occurred before 1950, another one in the mid-1950s, another one here, another one here, and then we had all these pullbacks along the way. Those are cyclical pullbacks. When you guys are looking at these movements in the stock market, the big picture eludes you that we are going up. This big picture of the big move eludes you because you're zoomed in so close that all you see is this downward move. And then you're going to say, why are you bullish on interest rates going up from 1941 to 1981? If I was an investor in the 1940s and 50s and I saw this breakout, I'd be like, go long on silver, go long on oil, go long on all these things. And that was still when we were on a gold standard. When we get off the gold standard now, I mean, these currencies are floating, man. Like this is going to be a big move. Now, what people are going to focus on, is my guess, is the short-term pullback that we're going to get in a big secular bull market. So they're focusing on this first pullback here, this big pullback, let's say. And the big picture completely eludes them. So they're going to say, why do you think interest rates are going to go up? They're going down. It's like you're in a cyclical bear market in a secular bull market. The big long picture move is up. The big long picture move is up, and we could get a pullback even down in the 2% range or lower, maybe even the 1 point something percent range. That's still possible and still be in a bull market. We are creating the higher low right now. And that's where people have no idea what the hell they're doing. They have no idea. And just to let you know, we did get a breakout in 2018, and they forced us all the way back down. I don't know why. Maybe they had to I don't know, something with SOFR or something like that, I guess. But they did some crazy stuff there. Here's DXY over time. Bottom and top of ratio is the last commodity bull market. So last commodity bull market in the beginning, this is the cycle, guys. Think of the cycle and then get really good at playing cycles. And that's how you make outsized returns. So the bottom of the commodity stock ratio was about where that circle is. The first initial thing, usually what occurs is oil goes up. Oil goes up, interest rates go up, so the dollar goes up in the beginning. We generally hit a slowdown period. That slowdown period is because interest rates have gone up and stuff flushes out of the system. So they flushed stuff out of the system, they lowered interest rates, and the dollar dropped with those interest rates going down. The top here is 2002. And then we went all the way down, and then we bottomed in 2008. The dollar did. And that's also when rates and the market peaked and all that other stuff, and then we consolidated for a while. The beginning of the bull market for us was about 2020, somewhere in this range here. You can see a drop, and then we increased interest rates, which increased the dollar up, just like we did here. This pattern here is going to be the same as this pattern here. We are going to pull back on the dollar like we did here and do a breakout of the uptrend line of that last bull market. We are doing the same exact thing. So some people say, well, where do you think we're at in the bull market? We're at the location of 2002, where we break down on the dollar. And then the initial impulse move lower of this is going to be created by a slowdown in the market. And that is where, if you were to look at oil like I had up here, we are in the same exact location as this circle is, right where I have the circle. So it's not that I'm guessing that this circle is here. I am using a gobload of evidence, like 100 different charts. The currency differentials, like Brazilian real versus dollar, Canadian versus dollar, Great Britain pound versus dollar. All of those currencies charts is telling me where this circle should be put, because the circle last time is the exact area of this one. The yield curve is in the same exact location. The dollar, the DXY, it's the same exact location. So it's not me reading one chart or two charts or three charts. It's me pairing together hundreds of thousands of data, doing it, looking at the data, using my brain to see what is the root cause, how is the herd of humans being subjected to these market conditions creating these patterns? If I can figure out the root cause of what is causing this, and that is how I came up with some of my other theses, with the real estate market being the driver of it, and these other things, the big credit cycle, which also plays a bigger role in it. It all interconnects. So I'm driving down, not because the pattern is telling me, it's because of the market conditions that the herd is subjected to that creates the patterns of these charts. So if I know that the charts are being driven by the market conditions, then I can go look to see if the market conditions exist. And if they exist, it means the herd is continually being subjected to those market conditions, which then drives the pattern and the outcome of the dollar getting weaker, let's say. Here's using latest weekly EIA inventory data. I'm calculating a WTI fair value at $82 a barrel. It is $14 undervalued from current prices. Anecdotally, spreads above $15 have represented attractive long oil futures opportunities. I may go long oil futures should the spread widen further. And whenever you get these disparities, that's when you want to go long. That is how you recognize the opportunity. It's when oil gets cheap to a historical dot plot, let's say here, of commercial inventories. We are $12 or $14 undervalued. Good time to buy. Oh, but we're going to have the greatest recession of the world. We're going to have this huge pullback and recession. I don't know about that, guys. Yes, we're going to get a slowdown, and no, we don't know what the outcome necessarily is. We are cheap, and we've got all these other factors that tied into where we are in the cycle. Are they right? Are they wrong? Could we get a pullback? We could. We could. We could go down even further. There's nothing saying that it can't. When you're buying cheap, that's all you can do. That's all you can control. You can only control if you can control your buying to buying when only things are cheap, and when you get some of these tailwinds behind you. That's all you can do. You can't force the market higher yourself. I can't. Warren Buffett can't. Nobody can. But what is the herd being subjected to where they might buy oil? A declining dollar. That's definitely going to be something that they might buy oil in. And we've got a declining dollar. We've got a increasing interest rate environment. What does that mean? It means oil goes up in it. What about these big last bull markets? We are at the top of a breakout. We are created a higher high, and now we are creating a higher low. That's a bull market. I tie it all together. Just seems more obvious to me, I guess. Paul says, oil prices are getting kneecapped again. How do you oil and gas investors survive this volatility? I think this is the end. I think we're getting close to the end of trend move. So at the end of consolidations, let me go back to this up here. At the end of consolidations, a lot of the times you get like one last surge lower. So if we look at this, at the end of this consolidation here from 1980, which is the peak, all the way to the bottom of 1998, which was the beginning of the bull market, last bull market, where commodities were cheap against stocks. Look at the bottom here. We had this fake move to the downside. I call that the slingshot cheetah. So we came on, we had a big pullback, and then it slingshots it up. We had another big pullback here after the first wave. We got a second wave pullback. We are in the second wave pullback. The question now is, how low do we go? No one knows that answer. No one knows it. So then you have to develop strategies. Well, then how do I get the cheapest prices knowing that something is undervalued? And I think that it will continue to go up into a new wave 3. And that's the strategy that you should adopt. It shouldn't be that I can predict where the price is going to go necessarily. It's about trying to get the most amount of shares at the cheapest price and do that in an undervalued asset. So that's the name of the game. It's not about predicting and making predictions right. It's about understanding the cycle and trying to get a good entry point and then getting the cheapest share. So what strategy should one adopt to do that? That's the answer. That's the answer you should be looking for. Coming back down here, we've got the stock market hasn't seen a single green day in September so far. The September effect is real. Big down move there. Utilities are now the best performing sector in the S&P 500 year to date, tech in second. Utilities generally outperform during a slowdown. a lot of the times. Warren Buffett says an investor needs to do very few things right as long as he avoids big mistakes. And the dividend dominator says the longer you stay invested in the stock market, the lower your chances of losing money. Patience, because most people don't have patience. I tweeted this. It says the top 10% of earners pay 75% of the income tax, and the bottom 50% of earners pay only 2.3% of the income tax. And some people were saying, well, what percentage of the top income earners do people pay? I can tell you this. I've been in the bottom 50%. I've been in the top couple percent on some of my years of earnings. I pay way more in taxes being in the top than I ever did in the bottom. You pay nothing down here, guys. Absolutely nothing. And then these guys down here, they all get equal say, even if they pay zero income tax, they get equal voting rights for those. And the one thing I don't like about our system is that the bottom people can literally vote things away from the top people. And I'm not talking about the 0.01% that shelters their money. I'm talking about people that are in the top 10 to top couple percent. Those are the ones that probably pay the lion's share of almost all the taxes. And I don't think you should be able to vote property away from someone else. And your income is a part of property. Before 1913, we did not have income tax. Before 1913, the Federal Reserve creation. So just keep that in mind too, that maybe we don't even need to pay this tax if we get rid of Federal Reserve. Jesse Felder says, we're not going back to this world of very reliably low inflation and low interest rates. Therefore, with higher inflation and higher interest rates, things are going to be more volatile. And it says, this is Ken Rogoff. He says, we will see more spikes in inflation. Do you know why he holds that view? He's taking the secular view because we've broken the downtrend here in interest rates. That's why he's taking that view. The downtrend is done. So you have to change your paradigm of that downtrend to the new thing here. That's why he's saying that. Gary says, oh, we don't need to go over that one. I think we'll probably, oh yeah, okay. So we can read it. The 12th test of resistance this morning. It's amazing. It's simply amazing how little patience most retail traders have. We're in the middle of a breakup from a 13-year cup and handle pattern, for heaven's sake. We've gone through the frustrating sideways churn as metals worked off their overbought condition from the powerful spring rally, and now we're in the next leg of the rally, and most people are afraid to pull the trigger because the price might drop for a day or two. And if it does drop for a day, they say metals are a complete waste of time. Seriously, expand your charts and look at the big picture. Completely agree. You have to learn. If you want to pull money out of this system, you have to learn how to play the game. You can't force the game to be the way that you act or want it to be. It doesn't work that way. JC Parrott says this chart from Goldman Sachs of no one using ChatGPT anymore is making the rounds. Wasn't AI such a fun story for people in the business of telling stories? So fun. Was it fun for you as it was for them? Number of monthly visits to ChatGPT website in millions. Huge adoption and then all the way back down. Why? Because it doesn't do anything. At least it didn't do anything for me. Meg Insider, energy buying. There's a whole bunch of people in the energy sector, insiders, buying up a whole bunch of stock. What does that say about the energy sector? Undervalued. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Mayday coupon code is still active. And that's all I've got for today, guys. We do have later on a question and answer session at 5 p.m. today. If you're a member on the website, that's where I sit down and answer whatever questions you have. I share my opinions about it. And I'm going to show you coming up a little bit about precious metals, longer term, big picture view. Get you guys more of the big picture view on this stuff. But that's what I've got for today. We'll catch you next time. This is Finding Value.